Yeah, hello all. Good morning. So, welcome to this short video to understand yesterday's Bank Nifty move and how, with the help of order flow and certain basic concepts, we could have understood what is happening in the market. So, first, as we can see, this is a 15-minute time frame chart of Bank Nifty futures. So, one thing what we must clearly observe is, like, for example, the price. If you consider, start from this low, the price makes a high, right, and then comes back, retraces. So retracements are very healthy. So and then makes another high, like it retraces, and then it also makes another high. So what price is doing every time it comes back, it makes a new low, it retraces, it makes a new low, and it uh, reaches a new high. So now see, whenever the price is doing this after a high to high, there is a significant difference. What I mean to tell is, from this high to this high, you can see naturally that the difference is been very large. But from this high to this high, there's not much difference. This is how you spot exhaustion when the price is going higher. It's not able to significantly go high. Now this, assume that we are seeing the chart in retrospect, and let me also hide the yesterday's bars to understand what the price is trying to do. So now, if I have to do this analysis in a miniature way. So this is how the price, you know, so this is the condition. So now what happened? Just a minute. Yeah. So yeah, see now what happened? The price, opened gap down because of global cues, and you see the price opened at around the same support level. Around this support level, price opened here and tried to bounce, right? So just observe closely. And then the price, spent some time there, and it is not able to go back to its previous high. So when the price is not able to go back to its previous high, that itself is a sign of exhaustion for that moment. I mean, it means to say that the price, whatever high it has made from this high to this high, it needs some more retracement, because it is showing some signs of exhaustion. It is not able to reach the high here itself. So it is somehow trying to reverse from the same level. So now, what happens in this case? The chance of this swing getting violated becomes very high. And as we can see, let me, yeah, this swing. What I'm talking about is this swing getting violated becomes very high because it's not able to go back to its previous high. It means that the swing low, I mean the previous swing low, is at some threat. So now you can see that the price. I think. Yes, so just observe this carefully, and yeah, so when you forward it, so it comes here, it just reverses, and then you can see one big bearish candle. So you can see the strength of the selling pressure there, and it breaks the swing, this swing low. uh, it was broken at this level. So yeah, it spent some time there because it was a swing low, and then it broke that swing. And one uh, some hammer time of candle was made below this swing low. So now what has happened? The price has broken this swing low. Now this swing low is temporarily invalidated, right? It creates a new swing low. So what happens? We must try to understand which is the earlier swing low. Like for example, this is the earlier swing low, and from this swing low, we must try to understand where the price has kind of topped out. Like for example, if you use the Fibonacci tool, so this swing low, what I'm talking about is this swing low, right? So this low to the high. Just observe. This is the price. I've taken the high, so as to get the retracement level. So it is still at the 0.5% level, right? So now, if the price is at 0.5 and it is able to cross this 38% level, then it will get back its strength. Oh, observe again. but price is not able to get back above the 38% level. In fact, it gets rejected. You can see that uh, it gets rejected from the same level. So what does it mean? The price is about to get back to point 0.5, and even point 0.6 is a preliminary analysis. So you can see that it also breaks point 0.6. You see, it broke point 0.6 and it temporarily bounced, but still there's no follow up. So it bound, it takes out point 0.6 and it is heading for point 0.7. You can see, and it broke point 0.7, and ultimately I think it closed around the same level. So this is how from the, so now this previous swing is still intact. I mean, if you have to analyze that when this swing is invalidated, you must go to the previous swing, take the levels from the low to high, and see what the structure is broadly doing. So you can see that for this swing, the price is still at 0.786 level, which is also a good. I mean, in terms of corrections, it is a good price correction for this swing. So we are just seeing this in a 5 minute time frame. Sorry, 15-minute time frame. So you can see that for this time frame itself, the price is retraced 78 percent. So which is a good retracement. So one more thing, what I want to convey here is that when you look at the swings from the intraday perspective, also you can catch the direction. Like for example, now I think this concept is at least clear. Now, when the price within intraday gives you a swing high and swing low, for example, just focus on the intraday perspective. Like for example, this high and this low. So I'll just recreate this. Like for example, look at the price here. So when the price comes to a low and just bounces. Now, how to measure the strength of this bounce? So, strength of this, obviously, the price itself will tell that if it is bouncing beyond a certain level, maybe zero point 0.5 or maybe zero point 0.6, like zero point 0.5 or zero point 0.6, then we think we can think that the reversal is on, and it will take out the previous swing. But when it is not able to do so, when it comes back and when it gets rejected at some crucial levels, right? This is what I'm trying to. I tried to post in yesterday's section, zero point 0.5 or zero point 0.3. I mean point 0.6 at the higher level. It's the golden ratio. So what happens? That it shows that the price is not yet ready for the reversal here, and it is heading for a new low. So this is what I tried to convey in yesterday's community post. Now observe this. Now, when you take the Fibo tool and try to get this high to this low, because it's very clear from the intraday that you find that the price you know first gets rejected at zero point 0.5 level and is not able to close below. First gets rejected at 0.382 level, and it's not able to cross the zero point 0.5 level. So it means when an instrument is not able to cross the zero point 0.3 and zero point 0.5 in whatever direction it is, heading in the same direction. So it comes down, it and it is going in the same direction. Now, till where it can go, that also Fibo will help, because when it comes down, it's obvious that it will reach the previous level, right? It will come back and it will reach the previous level, but beyond that, where it can go, that is the it's like predicting till where the levels can go. So that if you find here that it has reached the again these Fibo levels on the extension side. So if you can use these ratios, again the same ratios on the negative side, it gives extension on the downside, likewise on the upside. So you find that from this to this, these are the levels, and ultimately price hit both the levels. So this is how even these levels can be derived, and they become handy during intraday to get some price targets. Now coming to the order flow part yesterday, I mean quickly to see the order flow also. Here there are some certain red flags in the order flow which I wanted to convey. Like for example, the first candle. The first candle itself, it has an upper wick, huge upper wick. The body is green, although, but look at this. This is a red flag. When you see that from min delta to max delta to delta, there is a 60k, roughly 60k loss of green delta. There is a 60k loss of green delta. So this is not a good condition in the first candle. I mean, this is definitely a red flag uh, on the upside. And then see how the negative delta stacks up. Although the price doesn't go down here in the negative delta, it simply means that it will take another maybe short up move because it doesn't go down. And then what we must do is we must anticipate a kind of reversal around this zone, at least an exhaustion. So just mark the high of this and anticipate some exhaustion around this level. So you can see some more negative delta, and here there is although a good delta, but the issue here is since we have anticipated a negative thing, that we've seen some exhaustion at this level, so we must wait for some confirmations. So the issue here, what I'm trying to tell is why order flow is trying to be in sync with the open interest. Open interest also was negative at this point of time, but anyway, I'm not discussing open interest today. So the point is, it at this level, it is trying to see some kind of exhaustion, basically. So, and then you see a negative, I mean, red candle with the green delta, and that delta is having loss. So here comes the typical limit selling type of condition which we have discussed multiple times. So this is confirming, I mean, this candle is confirming the hypothesis which we framed here, that this is negative, right? And this is also confirming the negative thing. And this, there is no follow up. You can see there is no follow up for this increased delta, and this increased delta is not able to displace the price significantly higher. So overall, uh, when we see these conditions, I mean, the order flow giving a red flag in advance, we become very cautious. And as usual, we can see that the selling increased and the delta increased. You can see the increase in delta in the direction of. So this is now a strong confirmation. As we've discussed multiple times, delta increasing in whatever direction. So now it is downward direction. Now delta increased. So it's a proper confirmation that the price is heading downwards, and we can see again that delta further increased. Now, in this candle, we see that it's although made a red green candle, we are not seeing a significant loss of delta. See, now we have reached a high threshold delta, that's around 100k or 140k. Now, for 140k, at least half of it, think of, it's a simple logic that at least half of the delta should be lost for us to even think that some limit buyers have come to this level. But only for 140 to 100 is just 30k. 30, only 30k loss is it means nothing, right? Only 30k is nothing for such a huge delta, back to back candles. So you can it is just a relative analysis of the delta which you must do. Nothing that you must remember certain value or things like that. So, and then you can see that the green candles which come up have low delta, and it continuously keeps losing delta also. So, and finally you see again, again you see the same thing repeating, that there is increasing delta as it goes down. So finally, as we discussed, from the price and the order flow, both are converging to the same analysis, and price closed at the lower level. So overall, the point I'm trying to convey is order flow gives certain red flags in the beginning itself, that this up move is not healthy. So such flags we must always keep in mind. And obviously, open interest was negative at this time. And the point is simple: the price, reading the price levels also matters. So now, that does this mean that the price is heading downwards? No, it is a temporary break of the first swing. As I discussed, this swing itself is just broken, but the previous swings are still intact. At least if you see from this level, it is still at the 0.78 level, so which is still healthy. So overall, on the daily time frame, also you can see that the back nifty is pretty much healthy. It has given a one-sided rally. So for something which has given a one-sided rally, like this, retracement is healthy. So we must not think of any reversal till it retraces at least some zero point 0.5 or zero point 0.6 level, right? So if I have to show the fibo on this also, we can see that the price is just somewhere here, right? It is not even retracing 0.382 level, versus 41.8. You should, I mean, this is what I want to convey, that don't become bearish till it retraces at least 60%. So only when it retraces below 60%, then we can think of any reversal on a daily time frame. But this is just a small retracement which price does here and there quite often. So, and one more point I want to convey is that these retracements are very healthy. For the price to go up, it has to move in swings. So this is just one low. So I hope this analysis was helpful. Thank you.